Oh, it's the messy business of coalition building. And obviously, I mean, Ishiba has to go. He made a big bet and he lost it, and he's discredited. But I think the likelihood is that we'll see a period of haggling about forming coalitions. There will be coalitions formed, whether it's an weak LDP-led government, possibly with a prime minister from another party, somebody like, well, we won't go into all the names, it's rather boring and nobody knows them anyway. But the result is, look, let's look at the markets for a minute, Steve, and work the thing backwards. What's the market saying? The market's saying this is good for equities. Now, why do they think it's good for equities? They think it's good for equities because they say the next government of Japan is going to be extremely weak, whether it's led by the Constitutional Democratic Party of Japan or the LDP, going to be very weak. Weak governments, what do? Well, first of all, they don't tighten monetary policy. They're going to put immense pressure on the BOJ not to tighten monetary policy. Second of all, they do fiscal stimulus, so that's why the bond yields are going up. And third of all, the yen, of course, reflects what I've just said about monetary policy, so it will go down. And you go back to the same old game that we used to play 10 years ago, which is weak yen, fiscal stimulus, because weak political parties in power try to buy votes by having fiscal stimulus. So the yields go higher and Japan goes nowhere. That's, I think, what we're going to get, one way or the other.
There's a lot in there, David. Obviously, you and I would both be aware of the Bank of Japan Act of 1998 that said the government's authority is now limited in checking whether the bank's actions are pursuant on laws and regulations. That's just nonsense, then, is what we're saying. And there is zero independence for the Bank of Japan.
I'm not saying it's zero. I'm saying I think the independence of central banks in the world is going to wane, particularly as I think Trump's going to win the next election in the United States, which is, of course, a bigger thing than a storm in a teacup in Japan, even if it's quite a big teacup. But there is going to be immense pressure on central banks, I think, to do the will of government. That is the nature of weak and populist governments. And look, whatever you can say about the world, Steve, you can be pretty sure that you're going to have more weak and populist governments. And that's why central bank independence is not cast in stone, and they will be less independent.
OK, let's part that side of the equation. The equity side, knee-jerk, yen lower, against greenback, people start thinking again of the joys of the carry trade, especially when the other side of the equation is that there is a lot of people thinking the dollar's stronger for a whole host of reasons as well, good and bad as well. Why are you cutting back Japanese equity exposure specifically, given actually the weak yen benefits so many of those companies?
Well, there are two possibilities. One is maybe I've got it completely wrong. I've kept my JGB shorts on and I've cancelled my stronger yen positions. But I don't like buying equities on the basis of economic fundamentals which are coming out of the government and which are fundamentally unsound. Now, we haven't seen all that happening yet, but you can see, and I can see, the only reason for Japanese equities to go up from here is because the yen will be weaker and because investors believe their weak governments will have more stimulus plans. That's the only reason. Well, I don't buy into that sort of equity position because I don't think it's fundamental. When you buy Japanese equities, you should be buying them because they're doing something good about their companies. And they're making shareholders, they're creating wealth for shareholders, not because of shenanigans of weak coalition governments. That's why I'm not, filling my boots, as they say, with Japanese equities.